Good morning and welcome to the Killik and Co market update. The main focus this week has been results from NVIDIA. We do talk about this company a lot in these videos, and the reason is that the company has become so large that it has the potential to move the entire market. The company now accounts for about 8% of the S&P 500, and a move in NVIDIA can move the entire index. Investors almost view NVIDIA's results as an important economic data point, in the way that they might look at inflation data or GDP growth data. Markets were predicting that NVIDIA would report revenue of $46 billion for the most recent quarter. The actual figure was slightly above this at $46.7 billion. The company has grown revenues at a remarkable rate. Here's the trend over the last 5 years. Revenue in the quarter ended October 2020 was $4.7 billion, and the latest figure was essentially 10 times that. Despite the revenue beat, the shares dropped about 3% after the results were published. The reason was some comments that the company made about its business in China. There are a couple of issues here. One is that NVIDIA is now required to give 15% of its Chinese revenue to the US government, and the company said it is concerned that this may open it up to legal action. The second issue is that the company has developed a chip called the H20 specifically for the Chinese market, and this complies with US rulings that the company cannot export its best products to China. However, the Chinese government is now saying that Chinese companies should be using Chinese chips and not American chips. In its latest guidance, NVIDIA has not included any revenue for the H20 chip for the third quarter, which was a disappointment to investors, but this could change if the political environment changes. Despite the small drop in the share price after these results came out, the shares are still up over 30% over this year to date. There have been several headlines about government bonds this week across various countries and for various reasons. Firstly, in the US, Trump has been trying to fire Lisa Cook, a governor of the Federal Reserve, and this comes after his repeated threats to fire Jerome Powell, the chairman of the central bank. All of these threats have led to concerns about the independence of the central bank from the government, and as a result, investors have been selling long-dated US government debt, pushing up the yield on that debt. French government debt has also been in the news this week. Successive French governments have been trying to reduce the level of French government debt with limited success. The current government is trying to reduce the number of French public holidays from 11 to 9, and as a result, the government is expected to collapse in the near future, and as a result, French government debt has been sold off as well. While it has mostly been US and French government debt in the news, it's actually UK government debt that has the highest yield at the moment, meaning it is viewed as the least attractive. On this chart, we're comparing the yields on government debt that matures in 30 years' time and how these yields have changed over the last decade. For France in the pink, the US in green, Germany in black, and the UK in blue. The key points from this chart are that Germany's yield is the lowest. This has been the case for a long time. Germany has a relatively low level of debt, and therefore its debt is viewed as relatively low risk. French yields have risen notably in the last week, but UK yields are currently the highest, showing the concern that people have about the Labour government balancing its budget. And finally, the US has imposed a 50% tariff on Indian exports, and one of the reasons given is that India is continuing to buy oil from Russia. This chart shows Russian oil exports over the last 4 years and which countries these exports are going to. The EU is shown by the bright blue, the UK by the dark blue, and India by the yellow. You can see the EU and the UK were buying a lot of Russian oil in 2021 before Russia invaded Ukraine and all those sanctions were introduced. Since then, Russia's overall exports have hardly moved, and India has stepped in to buy what the EU was previously buying. The Indian stock market, shown here by the MSCI India Index, has had a good 5 years and is up over 80%. However, you can see the recent performance has been a bit weaker, and some of this is due to concern over US tariffs. Moving on to have a look at next week, it's looking fairly quiet on the calendar, but we are expecting results out from Salesforce. That's it from us. Enjoy the weekend, and we'll see you next Friday.